50% home price collapse will cause Americans to panic in the next 2 months. Everyone is talking about the housing market's uncertainty, potential crash, and warning signs. No one is discussing the reasons behind the uncertainty, like rising mortgage rates, declining buyer demand, and falling home prices. We will be covering experts' perspectives, comparisons to 2008, and factors affecting the market. In the past year, we've seen a significant downturn in the housing market across America, triggering the biggest decline in home prices in over a decade. As a result, mortgage companies are facing mass layoffs, and real estate economists are warning about a potential housing recession. It's raising concerns about whether we might be heading into another financial crisis similar to the one in 2008. Today, let's dive into the current state of the housing market, the red flags experts are warning about, and what this could mean for homeowners and prospective buyers. But hold on for just a second. We put enormous effort into producing data-driven content to show you what's fake and what's real. Subscribe and comment to The Final Economy. Boomers are finally awoken from a long slumber, only to immediately realize that their children will never be able to afford a house. One Gen Z buyer states, "I have been actively avoiding buying a house because I refuse to overpay by $300,000 for a 2-bedroom house that was $200,000 a few years ago and is 60 years old. Prices where I live are insane, and I'm seeing more and more houses staying on the market longer. It is really awkward that most of an entire generation has to sit here hoping for a collapse in the markets to ever have a chance of buying a new home." Starting in the summer of 2022, home prices have been plummeting, leaving homeowners and industry experts deeply concerned about the stability of the market. This downward trend has affected both sellers and buyers, as the demand for homes declines while supply continues to grow. With no end in sight for this housing market nightmare, there are widespread fears of a potential housing recession that could have far-reaching consequences for the overall economy. The recent housing market slump has led to the largest decline in home prices seen in 11 years, sending shockwaves through the real estate industry and beyond. The sharp drop in home prices has caught the attention of homeowners, real estate investors, and economists, all of whom are expressing serious concerns about the implications of this unprecedented decline. As the housing market continues to face uncertainties and challenges, experts are closely monitoring the situation, worried about the potential ripple effects it may have on the broader economy and homeowners' financial well-being. The severity of the ongoing housing market downturn is becoming evident through the mass layoffs occurring in mortgage companies across the country. As home sales continue to decline and borrowers face increasing challenges in making their mortgage payments, mortgage firms are feeling the impact on their operations. The increasing number of layoffs is seen as a clear sign of the approaching housing recession, causing further anxiety among homeowners and prospective buyers about the overall stability of the housing market and the potential consequences for the financial industry. The National Association of Realtors, NAR, has released a report shedding light on the dire state of the current housing market. According to their findings, home sales have been steadily declining for 3 consecutive months, raising significant concerns about the health of the real estate industry. The report also reveals that a substantial number of major housing markets are experiencing double-digit price drops, indicating the widespread nature of the downturn. The NAR's report serves as a warning sign for homeowners, real estate professionals, and policymakers, urging them to pay close attention to the unfolding crisis. The distressing housing market conditions are evident in the majority of the largest markets across the United States, where double-digit price drops have been reported. This widespread phenomenon indicates that the housing downturn is not limited to specific regions, but is affecting many prominent cities and metropolitan areas. Homeowners in these markets are facing significant challenges, with their property values sharply declining. These double-digit price drops are raising concerns about the potential impact on homeowners' equity and the financial stability of the broader housing market. Industry experts are closely monitoring the situation to assess the extent of the crisis. Certain housing markets that were considered overvalued are now bracing for a significant blow, as experts predict a staggering 50% drop in home prices. These markets have experienced unsustainable price growth, leading to inflated property values. The correction is expected to be severe, impacting both homeowners and prospective buyers. As the bubble bursts, concerns arise about the potential ripple effects on the overall economy and financial stability. Homeowners in these markets face the risk of losing a substantial portion of their home equity, while buyers may find themselves priced out of the market altogether. Cities like San Francisco, San Jose, Phoenix, and Seattle have experienced double-digit price drops, with some areas reporting declines as high as 25% from their 2022 peaks. As these once thriving markets grapple with substantial price corrections, the broader implications for the local and national economies remain a significant point of concern. In response to the ongoing housing market turmoil, major mortgage firms and banks are anticipating additional price corrections. Companies like Vela Mortgage and Goldman Sachs are issuing warnings about overheated housing markets in certain regions, such as the Southwest and the Pacific Coast. Experts fear that these markets could experience another decline of over 25%, leading to higher delinquencies for mortgages originating in recent years. As financial institutions brace for potential losses and adjust their lending practices, the impact on housing affordability and market stability is a subject of intense scrutiny. As home prices fluctuate and mortgage rates rise, affordability concerns have become a significant obstacle for prospective buyers. The payment-to-income ratio has reached alarming levels, surpassing pre-2008 financial crisis levels. Homebuyers are now required to allocate a larger portion of their income towards monthly mortgage payments, making homeownership a more challenging goal for many. High levels of household debt and rising unemployment also contribute to the affordability crisis, leading to reduced buyer demand and affecting the overall health of the housing market. The prospect of rising mortgage rates is leading to reduced buyer demand and driving down home prices. As borrowing costs increase, potential buyers are adopting a wait-and-see approach, hoping for rates to stabilize before making a purchase. However, this reduced demand is putting downward pressure on home prices. Sellers who once benefited from a seller's market are now facing more challenging conditions, with homes staying on the market for longer periods. The situation is creating uncertainty in the real estate market and raising concerns about the potential for a prolonged housing slump. Prominent experts and investors are expressing grave concerns about the looming disaster in the housing market. These warnings come from individuals with experience in predicting and profiting from market downturns, adding credibility to their predictions. Among these voices is Dave Burt, CEO of Delta Terra Capital, who was involved in predicting the 2008 financial crisis. The growing chorus of cautionary voices underscores the gravity of the situation and prompts both industry players and the general public to be vigilant and take necessary precautions. Analysts and economists are drawing parallels between the current housing market conditions and those leading up to the 2008 financial crisis. The volatility and vulnerability observed in both periods are raising concerns about the potential for history to repeat itself. As indicators reminiscent of the pre-2008 era surface, including rising unemployment, increasing household debt, and a lack of affordable housing, the likelihood of a housing market crash gains credibility. These comparisons serve as a stark reminder of the need for vigilance and prudent decision-making to avoid potentially catastrophic consequences. Several key indicators are pointing towards the possibility of a housing market crash. Rising unemployment rates are a clear red flag, as job losses can lead to mortgage delinquencies and foreclosures. The surging household debt levels also pose a severe risk, as increased financial burdens may result in mortgage payment defaults. Additionally, the end of remote work arrangements could impact housing demand, particularly in regions that experienced a shift in buyer preferences during the 2020 events. The combination of these indicators heightens concerns about the potential for a widespread housing market downturn. The Federal Reserve is closely monitoring the housing market and expressing concerns over its stability, especially in the context of interest rates. As the central bank considers its monetary policy, it acknowledges the influence of housing market fluctuations on the broader economy. Rising interest rates could hinder housing affordability and reduce demand, leading to potential financial stress for homeowners. The Federal Reserve's vigilance signals the significance of the housing market's health in shaping the nation's economic landscape and underscores the need for proactive measures to prevent further instability. Economists and housing market experts are making unsettling predictions about median home prices, foreseeing further declines shortly. The expected drop in home values is likely to have far-reaching consequences for homeowners, with the potential for a peak-to-trough crash in some markets. This means that property prices could plummet to unprecedented lows before stabilizing. The anticipation of such a crash has buyers and sellers anxious as they navigate the uncertain landscape of the housing market. The accuracy of these predictions will play a critical role in determining the severity of the impending housing market downturn. In conclusion, the housing market in the United States is currently facing a daunting and challenging situation. The nightmare of a widespread downturn continues to escalate, with home prices experiencing the largest decline in 11 years. Overvalued markets, particularly in West Coast metros, are among the hardest hit, leading to grim predictions of a 50% drop in home prices. Major mortgage firms and banks are also anticipating further price corrections, adding to the growing concerns about affordability and the high payment-to-income ratio that impacts buyers. The reduced buyer demand, coupled with rising mortgage rates, is pushing homeownership further out of reach for many, and experts are comparing the volatility and vulnerability observed in today's housing market to the prelude of the 2008 financial crisis. This has prompted the Federal Reserve to worry about the housing market stability and its potential impact on interest rates. Various indicators, including rising unemployment, escalating household debt, and the end of remote work, are pointing to a possible housing market crash. Economists and notorious investors alike are sounding the alarm, warning of an impending housing market disaster. The outcome of this crisis will not only affect homeowners' financial well-being, but may also have broader implications for the overall economy.